All right, folks. Hey, today I got a bombshell to drop. Hopefully, you won't lose all respect for me when you find out what I'm doing with my bucket 3 money. This is my growth money. I've had other videos talking about where I'm invested in bucket 1, 0 to 5 years, bucket 2, 5 year to 10 year. Okay. And so this is money that I need starting in year 10, after year 10. I use actively managed funds. Hopefully, you did not lose all respect for me with that last comment. I do have a little caveat, little asterisk I want to put on there. I have some Roth funds that I'm not including in this analysis. It's only about 5% that I have in indexed funds. But I wanted to go through my analysis of and my analysis and how I got here using managed funds. And you tell me at the end whether you think I'm crazy or not. I'm going to try to throw a lot of data out there to you. I got several screens working here in my little cheat sheet, so this may not be my smoothest video, but hopefully you'll like the content. So why do I use managed fund when everybody knows that index funds always beat, once you factor in fees, always beat managed funds? Well, let's go and see. So I'm going to share my screen here. This is Portfolio Visualizer that you are looking at here. The data only goes back to 1997. I didn't pick that date. That's as far back as it goes. So that's 27 years. This is because of, I believe, the total stock market fund that I'm comparing my managed fund to only goes back that far. So I put $1 million in there, went to 2024, essentially into 2023. I got no rebalancing in there. I've got the funds labeled Joe's Bucket 3 and index funds. I am going to go into detail in a little bit. These managed funds that I use, they're all American funds, and I will include their ticker symbol in the text for this video, so no need to write these down. So just kind of absorb what I'm saying here. So I've got 1, 2, 3, 4, 5, 6, 7 in managed funds. 5% is in this small cap world fund, and then basically 15% in all the other funds, with 20% in this top fund. It's AMCAP. So that equals 100%. And there's about 17% international in here, which I like to have international exposure. That's a whole separate conversation, whether you want to have that. So in my comparison funds, I got the total stock market, VTSMX, 83%. And then I got the total global XUS at 17%. So it's 100%. So managed funds with a 17% exposure to international, to index funds, 17% international. Let's check it out, hit analyze, and we'll go to the summary first. Joe's Bucket, final compounded annual growth rate, 9.59 versus 8.59 for this essentially 26, 27 year period. 1% difference. The blue line is my bucket 3. What is going on here? We'll dive into this a little bit more. Where the managed funds did fantastic for me is 2000 to 2010. During the lost decade, really did well, and then just kind of maintained their performance over the years. You know, with $1 million starting, you end up with almost 11.9 here, and you have 9.3, let's say, in the index fund. Let's go out here to let's look at the best year, 32, worst year, 36 in Joe's fund. Best year, 32, essentially the same under index, but the worst year was a little worse. Sharpe and Sortino ratio. Probably never heard of those, but they measure volatility versus a safe asset like 10-year T-bill. I'm not sure exactly what they compare it to, but it's a safe asset. Look at how much less volatility. This higher is better. My bucket 3, I mean, that's 20%. Okay, and then the Sortino ratio measures just the downside variability. So, you know, you don't care if upside variability is good, downside variability, 0.67 versus 0.83. So the volatility downward is less, the volatility in total is less with my managed funds. So let's go to, and this portfolio visualizer is free, folks. This is super cool. And it's back tested, it's all looking backwards. So let's look at exposures. Okay, you come out here and it's got large cap value, large cap growth, mid cap, all these things down here. And you'll see that these funds have a lot of similarities, and I tried to get them to match, okay? But large cap value, my bucket 3 is 19%. This is probably the biggest difference versus the index fund has 29. But see, large cap growth is 40 and 40, basically. Mid cap, 1.63, 2.85, it's pretty close. Here's another big difference, mid cap growth, 10.5 versus 6. The global ex-US 13 versus, you know, essentially 13. Here's the biggest difference. I have a balanced fund in my managed fund, so there's 8% short-term treasuries in here, and got some long-term treasuries where they're don't have any here, which should be a drag, you know, going back the last 10 years. Should be a pretty good drag on these returns of 8%, but didn't work out that way. So I looked at, you know, you saw the graph. So let's go to rolling returns. I like looking at rolling returns, say, okay, for 1 year period, this is Joe's bucket here, these 3 columns, and the index fund in these 3 columns. So 1 year rolling returns, or 1 year returns, 10.27. versus 9.49 for the index funds. Advantage managed. 3-year rolling returns. So taking all 3-year periods, you know, so 97, 98, 99, 98, 99, 2000, all those 3-year rolling returns, 9.18 versus 8.1. Advantage managed. 5 years, 8.59 versus 7.56. Advantage managed. 7 years, 8.7. 7.8, advantage managed. 10 years, 8.53 versus 7.75, advantage managed. 15 years, 8.28 versus 7.50, advantage managed. And these portfolio visualizer takes into account expense ratios. There's about a 0.66 expense ratio with my funds versus like 0.07 or something like that with the other funds. So this has it all in there. So let's see if I covered everything. Fees included, rolling returns. If you want to look at where these managed funds really dominated, let's go 2000 to 2010, okay, which was a very rough time in the stock market, the lost decade. Let's look at these 2 funds and look at my managed funds, almost 3% better for 10 years, 11 years, actually, 2000 to 2010. So almost 3% a year better. That's quite a bit, and that's really helped my returns during that time period. So that's the portfolio visualizer look under all those rolling returns, 1, 3, 5, 7, 10, 15, 100% of the time, managed funds better. The exposures, I tried to match international. And if anything, the managed funds have a lot more bonds in there and should have been a detractor, and actually, still the managed one. So, hey, now this is the next chart I'm going to. This is the American Funds propaganda site. Okay, so I'll say that up front. This is a chart looking at the S&P 500 index. S&P 500 index is here in brown. And then here's some select index or managed funds that I use. The Growth Fund of America, AMCAP, Washington Mutual, Investment Company of America, and American Mutual Fund, and look how they did versus the S&P 500. This goes back to 76, which is, pretty far back. So yes, some managed funds, especially my American funds, have done quite well. Now, you may ask, I'm going to back-to-back test here. Actually, I'm probably going to stop sharing here. Let me see if I can figure that out. Give me just a second. All right, I think I stopped sharing here. How did I get into American funds? Folks, they were in my 401k, the only option we had in 1987. So I'm not brilliant. I stumbled into this. Only thing I had, I've been with them for 37 years. American Funds has a team of advisors. They don't have a star advisor that's picking all these funds. They have a team of advisors. For example, they'll have somebody that's an expert on small caps, somebody that's an expert on mid cap, somebody in large cap value, all these different experts that are on this team, an expert on US, an expert on international large cap, international. So all these people come together and they form a team, and they have to invest in the funds as well. But they come together and they say, this is what we want to make up this fund. They had, and this is just off their website, 21,000 company engagements. So this is them meeting with leadership teams, touring their plant, being on conference calls, looking at their KPIs, looking at their budgets, looking at their balance sheets. 21,000, that's a lot. Deep understanding of the company that you're investing in, okay? People. I'm an engineer, okay? I feel best when I use data to make my decisions, okay? Now, this is about me. This may not be you, but I feel best when I do that. I feel best when somebody's driving the bus, looking at the speedometer, looking at the gauges, at what's going on, okay? Now, call me crazy for doing that. That's what I've been doing for 37 years. Indexes have had a great past. They have low fees, lower stress. You don't have to worry about beating the market and getting, losing to the market. You just get the market. It's a much more relaxed retirement, I believe. Much more easy investment life. But that's no indication of what's going forward. Now, I do go through a cadence every quarter. I compare what my funds are doing versus the S&P 500 versus the total stock market. I make all those changes, and I try not to make any investment changes, based on 1, 3, or even 5 years of performance. I'm looking at longer term trends, because things seem to have, you've heard of reversion to the mean. Something that I've invested pretty heavily in is, small cap value. Well, it hasn't done well the last, 10, 12 years, but historically, you go back into previous decades, small cap value does pretty well. Got a dry throat, folks. So let's see if I'm covering everything here. Call me crazy. So the funds, AMCAP is number one. It primarily invests in the US growth of a company of any size, okay? So got a lot of mid cap, small cap inside of there. New Perspective is growth, but it's international, about 50-50 international US. They look at global trade trends, okay? So like if there's a war going on, just for example, or there's an election in a certain country, or United States, has an embargo against certain countries, and what's going to happen. The next fund is Growth Fund of America. They look for significant game-changing growth opportunities. Think of like Kathy Wood's ARC funds, something like that. The next one is American Balanced. They can go between 50 and 75% equities, the rest in bond funds. They're looking at dividend and some growth opportunities, so dividend funds and inside of there. Washington Mutual, they look for strong balance sheets and strong dividends. So this is like a value fund, companies of any size. Fundamental investors is also value stocks that they think are greatly underappreciated. People don't understand the opportunity that's in front of them. They just really think they're mispriced. But by looking at the balance sheets and growth opportunities at a company, not just labeling who's ever meets some equation of a value fund. Small cap world is companies that are less than 6 billion in market capitalization global. I'll add, like I said, I'll add tickers in the text below. I'm not giving advice. I'm not a financial advisor. American funds have done really well for me. There's now in these numbers, there's no sales charge. I got these through my 401k and I rolled that into my IRA. So no sales charge. And I get a financial advisor provided for me at no additional fee that I meet with as often as I want, at least 4 times a year, 1 time a quarter. I'm meeting with my buddy Neil, and his phone number is below. You contact him. I don't have any financial relationship with him other than he gives me some coaching on my money. So I really like him. Given today's economy, the innovation that's going on, you hear about artificial intelligence, robotics, autonomization, Bitcoin, you hear about all those things going on. The geopolitical things going on that's causing shifts in trade, like wars, a couple wars going on right now here in the beginning of 2024. I like to put my money in somebody that's watching the business metrics. They're watching what's going on in the world, what's going on in the economy, and kind of looking at companies that have an advantage in that situation. Perhaps I'm wrong. Perhaps good chance I'm crazy. You can get my wife to agree with you on that. Regardless, it's what makes sense for me. It's what gives me comfort that I have people going into plants, and this is my background. This is my background as an engineer, as a location manager, 3 different sites. This is how I ran things, by looking at numbers. So that makes sense to me. Okay, so in the comments, tell me I'm wrong. Tell me I'm crazy. Now, don't just tell me I'm stupid, okay? But tell me what I'm missing in my logic by having these American funds, which have done great for me, as the data showed, over long periods of time. It's Joe out.